This is Niall from Learn to Trade the Market. Today's video is going to show you a very high yielding and effective strategy I've been using in the current market environment to take advantage of these nice trending cumbersome moves we've been seeing in the currencies. Okay, I'm going to show you the simplest strategy in Forex. It's the horizontal line approach. There's a horizontal line. That has so much significance in the market because everything occurs around these levels. Everything occurs around horizontal levels, and there's a nice example of a trend. All we've got to do is mark these levels on the charts and continue to watch them and look for price action to occur at them. So we're going to be combining two things, and that is trend confluence. So that's trend confluence and line confluence, or we might even substitute a level in there with that one. So line or level confluence. The strategy that makes most money, most of the money in the institutions, is the horizontal line approach on any time frame. I'll tell you why. If you're trying to move $1 billion or even $1 million, do you think you're just going to go into the market at any old price? Any old price? I don't think so. I think you're going to actually decide what level you want to cash in at or cash out at. I think this horizontal level might be 100. And I think Bank 1, we'll call it B1, has sold the market at 105. And the market's trickling down. I think he's going to cover his position at 100. I think he's going to trade around even numbers because he's moving so much money. He's just going to put a 0 and a 5 and a 0 and a 0 and say, alright, in at 05, out at 00, there's my trade. That's how a bank trader thinks. The retail trader goes a little bit more in depth and looks at the individual pips. The institutions, they trade off these levels. Okay? I think if the market has moved back to 105, Bank 2 is going to close out of his position that he bought down at 100. So he's bought here, and he's going to sell here. Really simple stuff. So these round numbers and horizontal levels, hugely important. So if we go to a simple strategy, which is a trending market with lower highs, right here, so lower highs and lower lows. We have a condition for a downtrend. We can now apply the horizontal level to the market. There we go, there's a horizontal level. We know that once this 1, 2, 3, this little trend break has occurred, that we can use that swing point there as reference. You see what happened there? I'll just go over it again. So we have 1, 2, 3 to initiate the trend. We then have the market move up towards that level right there. We'll call that 1. And old support becomes new resistance at point 2. Circle that. I'm going to enter a short. Right there, I'm going short. Looking for the market to retest this low and even potentially lower. What do you think is going to happen here? I'm going to mark that level right here, and this is what the market will probably do. It's going to trend nicely, it'll come back up, second chance for a short right there. Market has now moved lower. So that is the horizontal level approach in a trending market. The confluence is that the trend is in agreement with our trading direction, and the level has confluence with the trend. And then with these swing points, you see the relevancy right there, and again probably here, look for something around here, go short. That is the most profitable setup I've been using in the current market, and I'll just throw in a little wild card here. When you see that, that is a pin bar reversal. I go over that on all my other videos. When you see that when you see that on a chart and it forms at one of these levels, you know that there is a good chance of the market continuing the direction of the trend. Alright, so that's another little secret. Little pin bar at the level. Very high probability stuff. That's all I've got for today. Be sure to check out my trading course at www.learntotradethemarket.com. I'll be with you shortly.